Hello, everyone. You're watching the February episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. Want to give you a warm welcome. Also, to all of our guests, it is great to have you tuning in. Coming up on today's program, we'll examine a pair of recently launched global equity ETFs that seek to follow the footsteps of investing giants like Benjamin Graham and Warren Buffett. Also coming up, we're going to tell you about a suite of ETFs targeting different segments of the stock market. And finally, we will examine a new ETF that invests in U.S. stocks with a strict and disciplined value strategy. But first, before we go any further, let's welcome Maital Legum with the New York Stock Exchange. Maital, it is always great to see you.
You as well. I'm excited to be back.
Yes, so let's jump right in. Tell us about the latest activity and update on ETF launches.
So, following an historical year for ETFs, we might have expected that we would see somewhat of a slowdown, but there is no sign of that in terms of new launch activities. We are off to an extremely strong start with 70 new launches in the month of January, and we're inching really close to that 4,000 ETFs listed in the U.S. Most of the new funds coming to the market are actively managed, with over 85% of new launches this year in that category, with that expectation that trend continues.
Yeah, it's no secret here. Financial markets have been off to a pretty good start for the new year. How are the ETF asset flows looking? And then what are some other trends that you guys are watching?
No, we're coming off a remarkable year with over $1 trillion flowing into ETFs. And so far this year, we've already seen more than $100 billion in net positive inflows, signaling that growth is continuing at a record pace. Asset flows have been spread across a range of asset classes, but we saw nearly a quarter of all flows go into the Vanguard S&P 500 ETF, VOO, this year so far, underscoring the ongoing demand for low-cost equity exposure. We're also continuing to see strong interest in defined outcome and risk return strategies, especially following 2 straight years of strong gains in the market.
Man, we've also got a fantastic guest lineup on this show. What are you looking forward to on today's show?
So, I'm really excited to hear from some of our newest entrants to the ETF space, established managers who are making their debut into this rapidly growing market. Over the past few years, ETFs have skyrocketed in popularity, and now traditional asset managers are recognizing that shift, with many taking the leap to launch their own ETFs. Today, we're joined by successful managers who are bringing their expertise into the ETF wrapper. Not only are they offering their existing clients an ETF option, but they're also opening their portfolio strategies to a wider audience, making these innovative solutions accessible to all of us.
Yes, indeed, they are. And Maital, thank you so much for joining us. Keep up the great work. And on that note, let's dive right into this fantastic show. But first, just a quick reminder, you can check out First Look ETF on Amazon Fire TV and Roku. We also simulcast on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so don't miss it. Navigating global equity markets can be a daunting task. Many investors and even financial advisors lack the time and expertise to comb markets for stocks that may represent the best value. Well, a new pair of ETFs from First Eagle Investment Management aims to do the heavy lifting for you. And here to tell us more is Adrian Jones, Portfolio Manager with First Eagle Investment Management. Adrian, it is a pleasure to have you today.
Thank you. Great to be here.
The First Eagle Global Equity ETF, that ticker is FEGE, and the First Eagle Overseas Equity ETF, the ticker FEOE, are recent additions to your ETF lineup. Give us a quick snapshot of the unique investment strategy behind the funds.
Thank you. Sure. So the First Eagle Global Value ETF is based on our First Eagle Global Value Fund, which has a 45-year track record, applying value investing principles around the globe. And the overseas, which is just the non-U.S. portion, is based on the Overseas Mutual Fund, which has about a 33-year track record. Both of the ETFs are modestly more concentrated than the funds, and they exclude some of the less liquid positions. But as investors, we are bottom-up, fundamentally driven. We invest globally, and we have an absolute return focus, so we are benchmark agnostic. Our goal is to generate competitive returns, competitive absolute returns, with less volatility. For example, the Global Value Fund on which the ETF is based has over 45 years of beta of 0.65 and an average downside capture of about 40% of the MSCI world. So it's quite different. What makes us different, I think, from our peers, and certainly from the indices, are 3 things. 1, the companies we look for. 2, our patience, and 3, gold, which we own. The companies, we look for resilient businesses, and we seek to buy them at a time when the market is doubting that resilience. Now, compared to our peers and global indices, our holdings generally have higher returns, much lower leverage, and somewhat less cyclicality. And we try to find management teams that have sort of proven track records of prudent capital allocation. And this tends to yield a portfolio that looks quite different from our peer group and from the indices. So we have a very high tracking error to the MSCI World or the ACWI. The second thing is our patience. Our average holding period is 8 to 10 years. So we have very low turnover. The market seems to be getting increasingly impatient as years go by, and we like to take advantage of that impatience. We will add, we will trim, but we want to benefit from the compounding of the value of the business, not just the closing the valuation discount that we receive when we buy it. And then the last is gold. In the mutual funds, we actually own both bullion and mining companies as a hedge against sort of macro and geopolitical shock risks, as well as sort of the risk of fiscal irresponsibility and sort of the debasement of the US dollar long term. In the ETFs, we only own the mining companies. The ETFs are designed to reflect really our stock picking and to exclude the macro element of the hedge that bullion provides. But still, owning gold equities is not exactly common among our peers.
So what type of stocks might we expect to see inside FEGE and FEOE?
So in both ETFs, our largest sector allocation has been to consumer staples. And most people sort of yawn when I say that word, but it's not out of some defensive mindset, although we do have a defensive mindset. It's actually because these were businesses that were hit hard by COVID, by supply chain disruptions and inflation costs. And as a result, this group of companies in these businesses saw massive margin compression compared to historical fluctuations, and the markets panicked. So we added several percentage points to our fund exposure and in 2022, and both existing and new names. Several of those companies obviously have seen their margins and stock prices recover. Others have not yet. They're still dealing with other company-specific headwinds, so we still think there's a lot of value there. In the global ETF, our largest positions are Oracle and Meta. Oracle we've owned in other vehicles for a long time and patiently watched it develop its cloud services business, which appears to be gaining sort of a very good adoption at this point. And they are accelerating their build out. The market still has, I think, been quite skeptical about the long-term traction in that business, which is why it still trades at a significant discount to sort of the big three, Amazon, Microsoft, and Google. As for Meta, we actually own that and started buying that and the other strategies in 2022. It is a great, unique position in the advertising market that ability to micro-target audience. Obviously, it's a well-known company, generates prodigious free cash flow, and we think the valuation continues to be pretty undemanding on a normalized free cash flow basis. In the overseas ETF, our largest position is Imperial Oil, which we think of as the largest, best oil companies no one's ever heard of, even though it's a $30-40 billion company. It's an oil sands business in Canada, and it has a massive reserve base. They are profitable below $30 a barrel oil. Because it has very minimal capital requirements. So it's very heavy free cash flow. And this company has used that cash flow to buy back shares, over 30% of the shares outstanding over the past 5 years. And you could probably say about the same amount over the prior 5 years before that. So it is a rinse repeat business. It trades at roughly an 8% free cash flow yield, with just shy percent of a 3% of that is paid out in dividends, and the rest pretty much goes to buybacks.
So then how do you see financial advisors and investors using the First Eagle Global Equity ETF, which is FEGE, and then also the First Eagle Overseas Equity ETF, which is FEOE?
I think it really depends on the client. I think for those who are looking to sort of dip their toes into non-US markets for the first time, Global Value is a very appropriate vehicle. I think larger clients, those who want a dedicated international sleeve or are higher sort of risk seeking, might opt for overseas. But either one is going to give you exposure to our sort of unique approach to value investing abroad. So thanks very much.
And we're going to leave it right there. Adrian Jones, thank you so much for joining us. We appreciate your time.
Thank you.
Well, some investors have steered clear of stocks because of rich valuations. Rather than giving up, others are actively searching for investment opportunities within the stock market that offer value. Well, here to discuss a new ETF with a disciplined value approach is Billy Hwan. He is a portfolio manager with Parnassus Investments. Billy, it is a pleasure to have you today.
Thank you. Great to be here.
So before we talk about your firm's latest ETF launch, can you familiarize our audience with Parnassus Investments and its philosophy and approach?
Parnassus Investments is a boutique investment management firm. We were founded in 1984 and have about 100 employees based out of San Francisco. I think what really sets us apart is that we fundamentally believe that doing well and doing good are not mutually exclusive, but that they go hand in hand. So for 40 years, we have built a reputation as a leader in sustainable investing, proving that investing behind high-quality companies with strong values can generate attractive financial returns for our shareholders. Our investment philosophy is quite straightforward. It's tried and true. We find great companies, we invest with conviction behind them, and we hold them for the long term. We're really looking for companies that have durable competitive advantages, strong financials, and responsible management teams. And just as importantly, we do not invest in industries that pose long-term risks to our investors or to society at large. Sustainable investing is not just a filter for us. We believe that it's completely integrated into our investment approach, and this helps us identify resilient, forward-thinking companies that are built to last. We're also very patient with our investments, so we invest in them for the long term. We believe in utilizing the power of compounding to let our shareholders benefit from our exceptional research upfront. So in summary, at Parnassus, we're not just investing in companies, we're investing in a future that aligns with our values and supports our clients' financial goals.
So the Parnassus Value Select ETF, and your ticker there is PRVS, recently joined your firm's ETF lineup. PRVS screens for undervalued stocks in the U.S. market. Can you tell us how this strategy plays out?
The Parnassus Value Select ETF follows a large cap value strategy. So as value investors, we're looking for undervalued companies with strong financials and positive business prospects. We believe this is the best way to generate superior risk-adjusted returns for our shareholders. There's actually a wide range of value strategies in the marketplace. At Parnassus, we employ a relative value strategy, and that means we seek stocks whose valuations are trading at a discount relative to peers, to the company's own historical valuations, but who are also generating or exhibiting superior growth prospects. So we're highly selective. The ETF is concentrated. It's a best ideas portfolio. There's only 25 stocks in it. The stocks represent our highest conviction ideas for undervalued stocks that we think can perform well going forward. These are quality stocks. As I mentioned, they have increasing relevancy in terms of their products or services. They have durable competitive advantages. The management teams are strong, and they have sustainable business practices. So in practice, if we're looking at an investment idea, chances are the company is facing some type of challenge or setback. We believe that this could be an opportunity to determine, for us to determine if the setback is temporary and that the market has overreacted. We believe that the market is efficient over the long term, but can present opportunities when it overreacts in the short term. So we're looking for the small minority of cases where we can invest over a longer period of time and benefit from the rebound. So for example, one of our top positions is Pfizer in the ETF. Probably no other company has done more to change the course of world history by bringing the pandemic to heel with its innovative COVID vaccines. However, the fortunes changed dramatically when those COVID revenues rolled off and the stock fell over 50%, where we got involved as an investor. We think the stock can rebound, given their drug development pipeline has really been beefed up by their acquisition of Seagen. Their COVID franchise is stable. The valuation is less than 9 times forward earnings, and the dividend is well supported at 6.5%. And that's just one example. So in our portfolio, you'll find other examples of companies such as market leaders that are temporarily out of favor, established companies that are undergoing transformation, or quality compounders that are trading off price.
Yeah, thank you for sharing that example with Pfizer. Who is your target investor, and how might PRVS be used as part of an overall portfolio or investment strategy?
Yeah, the ETF is suitable for a wide range of investors, those who appreciate active management and also a disciplined value approach. This could include financial advisors and RIAs who like active ETFs and would recommend them for their clients. This could also include individual direct investors who understand the tax efficiencies of active ETFs over funds. I think what these groups have in common is that they both are looking for equity allocations that focus on high-quality, undervalued companies with long-term upside. In terms of how the ETF could be used, I firmly believe that it could be a foundational equity allocation for U.S.-based stock portfolios, or as a complement to a broader index-based exposure. Because the ETF's main features are high conviction, concentration, best ideas approach. I think that means it's particularly well suited as a return enhancer for existing core equity portfolios. Investors should be aware that because it has a smaller number of holdings, the ETF may generate a higher risk-reward profile in pursuit of outperformance. And if I could, I would like to just add some color based on what we're seeing in the marketplace. Because sustainability is fully integrated into our approach, we've seen this product and our strategies in general resonate very well with the millennial generation. This is a group that's confronted with the risks and realities of climate change on a daily basis. They're paying close attention to major climate events such as extreme heat, unprecedented flooding, devastating wildfires. They're also looking at emerging issues such as responsible AI, chemical safety in products, water scarcity, for example. So what we see today is that informed investors are really looking to asset managers like us who are paying attention to these issues and engaging with companies that are proactively taking steps to address them. So ultimately, Parnassus is a company that offers an approach that allows investors to both generate financial returns and invest according to their values.
It is an ever-changing world. Billy Hwan with Parnassus, thank you so much for joining us today here on First Look ETF. We appreciate your time.
My pleasure. Thank you.
Navigating the fast-growing ETF marketplace can be a daunting task, but Frontier Asset Management aims to minimize the complexity with its active ETF solutions. And we are very pleased to have Frank Pape, Director of Strategies with Frontier Asset Management, joining us here on First Look ETF. And Frank, it is great to see you.
Thanks, Stephanie. Great to be here.
Okay, so before we discuss your firm's ETF lineup, can you familiarize our audience with Frontier Asset Management?
Yeah, thanks, Stephanie. So what's kind of unique about Frontier is we're headquartered in Sheridan, Wyoming. Not many asset management firms in Wyoming, but we've been there for over 25 years now. We also have an office in Atlanta and Denver as well. Today, we manage just north of $5 billion in assets under advisement as of December 31st, ending last year. The bulk of those assets are in multi-asset portfolios. And what I mean by that, we have a series of strategies for advisors to use with their investors. They range from our core strategies, our tax managed strategies for those who care about after-tax return, income-oriented. We have some faith-based series. And lastly, for this conversation, we have a series of ETF multi-asset portfolios. These ETF strategies started over 10 years ago. So there's a track record there for advisors and investors to evaluate. At launch, we used third-party ETFs in these ETF strategies. As the ETF market has evolved, we're very excited to this last December, we launched some new ETFs that are now the building blocks of our ETF strategies. So we launched 6 new ETFs, and each of these ETFs are actually fund of funds, or specifically fund of other ETFs. So we're very excited to bring these fund of ETFs to the market for our strategies and for advisors and investors who want to build their own portfolios.
Yeah, so congrats on that. Today we're going to focus on your 3 equity ETFs. So let me go over the tickers: FLCE, FGSM, and FINT. Each fund targets a different segment of the stock market. Tell us more.
Exactly. So, as I said, we're trying to build multi-asset, fully diversified portfolios. So we need ETFs to round out those different asset classes. So again, we have 6 ETFs, active ETFs that we launched. We have 3 equity ETFs, 2 active fixed income ETFs, and 1 active absolute return ETF. And again, these are our fund of ETFs, as I said. And what's cool about them, for these member ETFs that we use, they can be active, they can be passive, they can be factor-based. We're indifferent where we get the return. We're trying to get the best combination of ETFs in these asset exposures that are going to benefit investors in the best way. And, again, we use these in our multi-asset portfolios, but definitely open the discussion for advisors who want to use them in their own portfolios as well. To give your listeners an idea how we're using them, in our balanced ETF strategy, we're allocating about 22% to the large cap ETF, about 12% each to the global small cap and the global international ETF, active ETF that we launched.
So do you want to dive in a little bit more to these three in particular, the equity ETFs? You have FLCE, FGSM, and FINT.
Yeah, thanks, Stephanie. Exactly. So for the large cap, the Frontier Asset U.S. large cap exposure, it is benchmarked to the S&P 500 and is like core exposure for investors looking for exposure to the large cap part of the market. And our goal is to outperform the S&P 500 with that ETF. The next one is the Frontier Asset Global Small Cap ETF. Just like it sounds, we're giving small cap exposure both for the U.S. and non-U.S. exposure. Somewhat unique to be able to, in one ETF, get exposure small cap for U.S. and non-U.S. ETFs. The third of the equity ETFs is that Frontier Asset International Equity ETF. And just as it says, international, it's both developed ex-US and emerging market. Today at launch, it's about 75% developed ex-US and about 25% emerging market in that exposure. Again, all these are actively managed, and we're excited to bring these to market.
Yeah, I mean, definitely something for everyone. What type of investor does Frontier's equity ETFs, those three in particular, who do those appeal to most?
Yeah, it really to the theme of this whole webcast that we're doing is there's just so much ETFs coming to marketplace. It's so challenging for advisors and investors to do adequate due diligence. And we believe by partnering with Frontier Asset Management, we can really help investors leverage their time. Again, we've been optimizing and putting funds and ETFs together for over 25 years, and we believe can really help investors to focus on other things that bring more value and partner with Frontier to get these core exposures to their portfolios and, again, and help their clients hit their long-term financial goals.
All right, sounds good to us. Frank Pape, thank you so much. We appreciate you. Good luck with your ETFs.
Great. Thanks, Stephanie.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. Want to give a big thanks to all of our guests, along with Maital Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks so much for watching. We'll see you next time.